The RBA met yesterday for its March meeting to discuss monetary policy, after which it decided to increase interest rates another 25 basis points, taking the official cash rate to 3.6%. That's the 10th hike in this cycle, and we've seen 350 basis points over that for the last 10 months of interest rate policy adjustment. The main reason for the continued hike in interest rates is that continued concern that inflation is still too strong, particularly in the services sector, less so in the consumer goods sector, which is keeping the RBA concerned. And their modelling suggests that policy needs to be more restrictive than it currently is. The February decision to increase interest rates, also 25 basis points, came with a very hawkish statement, and the RBA targeted ongoing inflation concerns, specifically around a wage price spiral where wages growth increases to compensate for inflation risk, and we continue on the roundabout there. This time around, the statement was a little bit more dovish, suggesting that the RBA is becoming less concerned, or not necessarily less concerned, but they're seeing signs that the labour market is cooling. Wage inflation is not as aggressive as it thought it might have been, and as a result could potentially look at pausing its interest rate decisions going forward, although that's a low probability event at this stage in time. So the statement was more dovish than February, and the language suggested that there are more interest rate hikes necessary given the data on hand. However, the language is softer than February, signalling that perhaps we only might see one more rate hike, and maybe another 25 basis points to say 3.85%, and then perhaps a pause going forward while we adjust and take note of what's happened so far. Another consideration is towards the back half of this year, we have a large volume of fixed rate mortgages rolling off. We're talking tens of billions of dollars of mortgages currently priced at 2% or less, rolling off into mortgages of say 5.5%, perhaps even 6%. That will have a significant impact on household budgets, and that is what the RBA is focusing on as well. What will that mean for household spending and in turn inflation going forward? So there is a degree of caution that perhaps they go too fast, too soon, and really send the economy into a recession, which is they're trying to avoid. As I've mentioned in these videos in the past, mutual limiteds funds are all floating rate. So we benefit, or our investors I should say, benefit from a rising interest rate environment. All of our securities have coupons that reset every 30 to 90 days. So as the RBA increases interest rates, the bank bill swap rate increases with it, and in turn the income generated by our funds is growing. So we had a very good month in February, in some instances our strongest month on record, driven again by rising interest rates, but also some strong credit spread performance as the overall technical dynamics of the credit market improve. We expect this to continue over the coming months, again with a potential rate rise further on in the calendar, but also some improved credit spread performance as well. So we're well positioned, and the funds have enjoyed some really good inflows over those recent months to benefit from the rising interest rate environment.